Hello, everyone. Good evening. Welcome back. So today we're going to be going through a lot of data reports. So particularly for student housing and multifamily. Just going to be reviewing just ones from trusted sources that I really like. So those would be RealPage and Yardi Matrix. They post, I would say, quarterly reports for the multifamily sector. They go through student housing, affordable housing, overall multifamily, like conventional multifamily. Just a lot of great content and reports that it's worth looking into. So just gonna be sharing some of those with you, and if you guys wanted to check those out, you can visit their websites, and they post all of them pretty much in their market research tab. So yeah, so pretty much the ones that I found through like RealPage and Yardi pretty much just went through like overall outlook for CRE and sorry, overall outlook for multifamily in 2023. Some big questions that they thought were intriguing, and I also agree with. And I think it's really key to kind of hone in your asset class, whatever it may be, and just kind of solidify your opinion through your market research and making your investment decisions backed by data and the facts that are out there with the sources, right? So the ones that I use, RealPage, Yardi, they've been in the business for a really long time. RealPage is actually one that is also linked with a property management software called Buildium. And I'm also going to do a review of their software as well, but really great content that they put out there. It's kind of mind-boggling how many different data points and statistics that they can kind of come up with the amount of users and customers that they have. So yeah. Um, so first one is going to be this five big questions in the multifamily housing space. So essentially, the first one here, it says, does demand remain sluggish in 2023? If so, to what degree and for how long? So as you've well known, that right now is kind of an ideal buying opportunity for multifamily. It's really a matter of when you notice that supply demand imbalance, you see demand lagging to supply, you know there's going to be price drops in assets, right? So basically, if you can just kind of just draw out your basic supply demand curves and see like where on the spectrum, if it's a dramatic demand drop, you're going to see dramatic price drops. If it's a pretty dramatic demand increase, price increases, right? So it's on that curve. Supply, obviously, if it decreases, prices tend to increase as well because of scarcity. And if supply increases, there's a lot more inventory in the market. It's a surplus of multifamily construction units and a lot more developers and contractors willing to take on more projects. Then you'll see prices drop significantly. So if you have just like basic fundamentals of those supply demand, you'll identify the best buying opportunities. And currently, right now, it's honestly one of the best. So I highly recommend just if you are wanting to get into the commercial space, just going into multifamily, seeing like the different sectors that are within that, and kind of solidifying your niche market is really important. So yeah. So let's get into this. Some quick data points that they kind of covered. So remember, net absorption is the amount of units that were occupied, subtracting the amount of units that were vacant. So positive net absorption is always great. Negative net absorption is not so great. So here you see in the 2022 quarters, third quarter 2021 and third quarter 2022, a dramatic increase in there, but then a pretty big drop off after that. So it seems that vacancy is kind of creeping up here and there. Depends on the different markets that you're looking at, but long-term average here, it says that it's around 200K. Now, albeit this is all real page market analytics, and some of it could be biased, but I'm just taking it with a grain of salt and just taking the things that I think are pretty intriguing. So yeah, here they also put in a lot of more sources. So like here, it's from the Bureau of Labor Statistics and FRED, which is the Federal Reserve Economic Data website. So that's also good to see. So non-farm employment, which is the main thing that people track with job growth. So you can find this through the BLS, and here it says that it's around 3% currently. Interesting. So still a drop off here. You see the employment, non-farm employment increase was upwards of 11% in 2021 after that COVID shock. So kind of a fluctuation right there. Something that we haven't seen in our economy in a long time. So resident retention, this is really important. So now people are really trying to figure out ways to retain their residents, because it kind of stinks when like a resident moves in, right? They agree with the lease terms and everything. But then they do like their own searching. They see that the rent that they're paying at the facility is not really at the market, or that they just find some cheaper options in the market. It's hard to kind of retain them, because they'll most likely 9 times out of 10 choose the more affordable option. And if it's same bedroom, same square footage, it serves the same purpose, and it's they're going to go with that one. And the person that loses that resident, it has to deal with that vacancy loss, right? So resident retention is huge. Here you see it's around 52%. So they track that, RealPage does, in each market, and sees where people are moving, like new lease trade out. Basically, people are moving in and moving out. So here you see leasing traffic, plummeting front door traffic caused very weak absorption in the peak 2022 leasing months. So big decreases in the leasing traffic there. Part of absorption slowdown can be summarized as demand that was pulled forward in the 2021 calendar year. Interesting. Lease-ups absorption has quickly moderated, potentially a proxy for near-term Class A expectations. Interesting. So you're seeing people, I guess, kind of stagnating lease trends, I would say. So here the number of units leased up has been decreasing. And then the number of units in lease up currently is portrayed here. So leased up versus lease up. So leased up meaning that they've already signed the lease and they're good to go, but you see that actually decreasing, which is not a good sign. Occupancy rates are very low right now, slightly below the rate heading into the pandemic. Well, slightly low, sorry. So yeah, you see the average around 95%, Class A at 94.7, Class C 95.8. And so yeah, so that was demand. So I would expect just in markets like, for instance, here in Philadelphia, we have a really like stable market. We don't see too much fluctuation in occupancy or demand for that, or supply demand for that matter. We actually do have one of the highest inventory like units that are actually either under construction or proposed projects actually in the Philadelphia area. It's one of the highest within the country. So it's actually, there's a lot of, because Philadelphia is a huge city, right? Like a top 10 city. You have tons and tons of pockets of different markets and sub-markets, tertiary markets. And there's a lot more development opportunity with older construction that has been distressed, or owners have either passed it on, and there isn't too much growth there. So you might see a demolition, a new development, sometimes even a gentrification building. And other times it's a really matter of finding what type of development fits in that particular area. So as a developer, it's good to just see like where the different pockets are and potential opportunities for development could happen. So yeah. So you see, let's keep going here. So this is a construction pipeline. Now, there's a lot of different sources that you can track construction. Obviously, you can see like proposed units under construction, proposed projects, planned projects, construct or under construction projects, and then deliveries, right? So it's kind of like a phase by phase um data that you can track. And honestly, like you can kind of scour through different brokerage sites as well and see like where people are posting like the best data for like construction pipeline. And then you can get a better idea about like which areas have more supply, and there you can gain a price advantage there, some buying power, and actually a pretty decent place to invest, right? So I highly recommend that. So here's some basic construction data that RealPage posts. So completions by calendar year, scheduled to surge 2023. Interesting, peaking around 600K deliveries, 3% inventory expansion. So multifamily 5 units and above. So 5 units and above is considered commercial. And the rest is below that is considered residential. So what is this? New housing starts by month. So you see multifamily has kind of steadily increased. I mean, usually like it's really weird how like the supply demand curve kind of works. Eventually it will meet an equilibrium and pretty much provide like a stable market for both buyers and sellers. But sometimes like when you notice that it's in that imbalance phase, it might be a good idea to either back off and kind of wait a little bit to invest, or kind of dive in and just go for it, right? So unit permits by not yet started. Oh, actually, they did release. So I kind of keep like a an archive of like a lot of reports, but RealPage did release like this permit data, showing the different markets throughout the United States that have like the most permit activity or the permit changes, right? So what I did was I just looked at this, right? And it's from I mean, it's a year by year tracking thing. So I just put my filters in here. Extend this out. So yeah, I just put my filters in here, and I just did it from ascending to descending, or sorry, other way around. So the ones with the most growth, right? And basically you see here Georgia, Indiana, Georgia, South Carolina, Ohio, see Harrisburg, Carlisle, PA, that's down there, Fayetteville, North Carolina. So you can see like the different markets. So let me just clear these filters. Yeah, so you can just see like from this, like the different markets that have been kind of growing in terms of construction and development activity. But sorry again if my voice is kind of low. I'm kind of battling a cold, but it's kind of getting cold here, Pennsylvania. But yeah. So yeah, pretty much that shows you which cities are having the most permit activities or more development activity. So a nice spreadsheet to kind of track that off of. And this shows on a yearly basis. So you can actually see like the ones that have been growing steadily year by year. So yeah, that was a cool one. So here you go, markets with greater than 10% of existing inventory under construction. So Nashville, Charlotte, Austin, Raleigh, Durham, Salt Lake City, Jacksonville, Phoenix. I'm more focused on the East Coast right now and also like mid-central markets as well. So I would be taking a deeper look into like Nashville, Charlotte, Raleigh-Durham. All of those are kind of like in my wheelhouse, but yeah, and then some other secondary markets here. So basically like if it's a larger percent of their total unit count is like under construction, that means that pretty much you'll see prices probably declining because the delivery phase and then the selling transaction phase, you're going to see a lot more supplies. I mean, properties come on listing services. So yeah, and then here you go. So market rate apartment construction, percent inventory growth. So you see the suburban areas kind of in the middle here. Urban obviously has the most growth, secondary markets at the bottom. So yeah, this was the one that kind of stood out. So urban markets to monitor for near-term supply pressure. So Philly, 32% inventory growth, tied for the highest or second highest in the United States. Nashville has the highest. And then they also track the units under construction. So Washington, D.C. here has the number one amount of units under construction. Here you see Charlotte at number 5 in inventory growth. Phoenix as well with tied with Philly for inventory growth. So yeah, and then here's some interesting submarkets that I may also not know too much about, and it's worth even with like conversating with brokers who are more local to the area. They can give you better insights into which markets are kind of appreciating more than others. So yeah, apartment rents, rent growth remains a key focal point for the industry in 2023. How do rent changes in 2023 impact renewals, and what does the near term future hold? So rent changes is a big factor in calculating returns. So you'll see some markets appreciating higher than others. And honestly, it depends on I guess like what the um trade out is, right? So new lease trade out versus renewal lease trade out. So what factors, I guess how much tenant activity is happening within a given year, and how many expiring leases are actually coming up in that year, right? So that's one thing to keep a lookout for. And then apartment rents versus single family homes. Obviously, single family has higher rents, but okay, so this was interesting. So most like commercial, when I say commercial, like office, industrial, retail leases have rent changes according to the CPI. That's something that I've just observed, but for multifamily, obviously it's a more in-depth process and doing a larger like market study for rent changes. But basically this is the blue is notified as the new lease trade out. So you see here in August, it was probably like the highest out of, asking rents are probably the highest, but in-place rents are mapped by what the tenants are actually paying. So you can see the actual loss to lease between that spread was probably the highest in like November or December 2021. That gap is it has a huge impact on bottom line NOI, because that loss to lease figure, that's honestly what the property is generating, right? So yeah, so that's something to keep in mind of. And then true renewal rent trade out, so that's marked by the light blue line. So that's existing tenants renewing their leases and the rent changes that are impacted by that. So that's that. Pretty cool. Renter incomes keep growing at moderating paces in line with rents. Yep, so change in household incomes versus change in effective asking rents. So yeah, so I mean, you'll see that like when you screen a tenant, like you're probably gonna get or asked for like a personal financial statement and actual average income for that year. So I always use like the 4x rule or the 25% rule. Basically like your rents should be whatever you're paying should be 25% or lower than your average household income. Basically, that shows that the tenant is able to cover their rents, cover their personal debt, cover personal expenses, and then still have money as savings, right? So that shows that they're in a good, affordable position to actually cover their rents and not become either delinquent or be late on their payments, right? So that's kind of a good rule that I use for affordability. Yeah, and then moving on here, you see the loss to lease figure right here. So was highest during that pandemic era. So you see that, and then has dropped since then, which is a good sign. Um, and then still recent cuts have been sizable in recent metro areas. So these are rent cuts. So some markets that stood out to me that I've kind of been tracking. So you see Nashville with pretty large rent cuts. Nashville at one point had like the highest rent growth in the nation. And I mean, it's normal to see now some taper off of rents, but this is still an interesting figure. See, Philadelphia is like honestly stable. It's literally like I feel like it doesn't change. Like there's just like so much like stability in this market right now. Um, a diverse amount of different real estate that's being developed, like life science buildings, huge office buildings, even larger community multifamily projects, right? But I'm still pretty bullish on Philadelphia going into the next quarter, um, or in the next year for that matter. But yeah, don't take it from me. I'm biased. I'm kind of a local, but um, still keeping high hopes there. Um, Columbus, Ohio, with pretty minimal rent cuts. That's one market that I've been tracking. Um, St. Louis, Missouri, with absolutely no rent cuts. So some of these markets, first off, you have to see like what their actual year-over-year rent change is, and then see like why their rent cuts are not like happening. So, for instance, Cleveland might not have that much rent change, right? But there doesn't have uh any rent cuts, obviously, right? So yeah, and then well, another question would be, how do rising expenses factor into the 2023 outlook, and what performance metrics will influence bottom line revenue growth next year? So operating expenses are huge, man. Like it's hard to avoid utilities, honestly. That's the biggest cost. And putting together a plan with like your engineers and kind of like the utility companies that you're um using as your vendors, seeing like where those cost savings can play a big role, especially for energy savings. Like, um, I mean, obviously implementing a ratio utility billing service keeps tenants more mindful about like using the water or using their electricity. Like, and it kind of puts a more sustainable initiative about just overall energy savings, right? So I really highly recommend just implementing like a ratio utility billing service. And that just helps, honestly. Here you see the costs laid out. Turnover costs are huge. So this is directly in your repair and maintenance budget. So basically like uh I mean, I don't know. I'm trying to think like how you would track that. So turnover costs, this can be anything from general administration expenses, office expenses, supply expenses. So if you are running like a property management company, you have a maintenance staff on board, you have a lot of excess material that is not in usage, those would be considered turnover costs, right? Um, Insurance, a huge expense. And I'm gonna actually make a video on insurance and how to kind of negotiate premiums or kind of understand just like how the insurance world works in general. operating and maintenance expenses there, administrative expenses, utilities, payroll. So honestly, like this is still, in my opinion, inflated. I always project rent growth the same as operating expense growth. Obviously, it depends on the market, but that's kind of like my default. Like I always keep operating expenses growing at the same rate as rents, right? Just takes a more conservative approach and just making sure that um, I guess the returns are kind of stable. Like you don't want to see fluctuating returns because that means you're playing around too much with the model and putting things out of sort. But last question here, what extent external economic forces will impact buyer seller activity beyond the new year? So I've noticed like I would say like in the September all the way up to November, I really saw like a larger bid ask spread between like the transactional market. But here you see sales completely down, like not sorry, not completely down, but a big drop from 2022 of January. So they were at their peak here in January 2022, and since then it's kind of dropped since then. So there are some a lot more deals still kind of lingering on the market. So if you are interested, just make sure that you thoroughly analyze it. But yeah, so cap rate trends, interesting figure, kind of mapping it with the 10-year treasury yield. So obviously cap rates kind of compress over time, being that property values are naturally going to increase over time. But so you see here that a slight uptick, not too much, but there are some affordable areas where like I would kind of suggest investing in. But yeah, so I mean back in 08, 09 when that crisis happened, you saw prices just completely drop, just dropped straight through the roof, hence this cap rate expansion. And then this treasury yield mapping the debt markets. Right now, I mean, this is at 4% in August. Right now, the 10-year treasury is around like 3.5%. Correct me if I'm wrong, that's probably not accurate, but just check out like the what's it called? The par yields. I think there's a website from the government, but yeah, so DSCR coverage here. Now you see why DSCR lenders put a minimum of 1.25 x as their ratio, just because that they want to see that people are able to cover their debt and NOI is kind of stable. It's at a decent amount, but yeah. So yeah, I mean, yeah, I always think that when you're underwriting, just make sure that you're taking that conservative approach. You're not putting things out of market just to shake out the returns in your favor, because that will not end well. Just go by whatever is in that market. Make sure that you have some sources to back like your underwriting, and that when you explain it to investors that they're also kind of comprehensive and they understand it, because that's the ultimate goal. You want to help your investors understand why you underwrote this deal at like 20% IRR, 15% cash on cash, like whatever it may be. So yeah. And then this is a student housing report that was done by RealPage again. So again, pretty lengthy. I'm just going to briefly just go through a few slides that I think were cool. So this first slide, effective rent change. So 4% effective rent change in student housing, occupancy kind of increasing. And then see vacancy versus number of vacant beds, vacancy rate decreasing. That's a good sign. This is okay. So in student housing, you have purpose built, which is student housing developments primarily targeted towards that university, like half-mile radius, like right in the university's campus. And then you have, I guess, competitive student housing. So that's outside of the campus. It's probably like a mile out. You're gonna see more people, I guess, or more demand in those competitive areas. And obviously it's kind of, you can track it either way, right? So purpose-built versus competitive. So this is some purpose-built data right here. And there was one purpose-built that I mean, versus competitive that I wanted to show you guys. So construction leaderboards, interesting. So see here, University of Maryland, Georgia Tech. Most construction happening in these universities. But yeah. Quick overview. Questions: site availability, both campus and location. How does on-campus housing change the competitive landscape? Shifts in enrollment growth. Where to watch? NOI, rising expenses, and the cost of debt. Changing renter preferences. So here you have just the share of total housing properties built by distance from the campus. So half mile away. Wait, what is a half mile away? Wait, share of student housing properties built by distance. So I guess it's showing the development growth activity. So you see more an uptick right here from 2021 to 2022. Obviously, the most growth is going to be near the university because that's where people want to be. They want to have an easy commute and direct access to the campus. They don't want to drive or walk too far to get to campus, right? So yeah. And then this is something that they track: enrollment to bed ratio. So depending on the people that enrolled, obviously they're going to be people commuting, right? Abroad students as well. So not all of them are going to be on campus or renting a bed, right? So the ones that have the highest enrollment to bed ratio um, shows that it's a larger campus. There's more students and there's going to be, I guess, less people renting. Oh, so actually, no, they're tracking the largest inventories in the market. So this was a actual bed count, and then this is that enrollment to bed ratio. So pretty much just showing like which ones have like the most potential to be rented out. This is on-campus rent versus off-campus rent. Off-campus is still, I mean, that's kind of the same, but trying to find that. Oh, this is an interesting metric. So Power Five is like the major, like I would say D1 schools. So like ACC, SEC, I mean PACs like Pac-12, Big East, like those are Power Five schools, I would say. And here you're seeing like the most enrollment percent growth by that. And this is a good metric right here. So essentially tracking all the universities that are in that Power Five or the top universities in the country and seeing the ones with the highest growth. So Georgia Tech, Purdue, Illinois, University of Washington. These are just ones that I know of. And University of Michigan's there. A lot more, but yeah, pretty interesting. I'm trying to find that metric that had like the competitive versus purpose built. Let me find that. Yeah, here you go. So this is national student competitive housing availability. So number of beds that are vacant and then the vacancy rate. So it's around like 3.5% right now, the vacancy rate. Purpose-built rent discount versus competitive, and then the percent difference. So obviously purpose-built, or actually I would think that competitive would have higher discounts just because it's kind of off campus and it's a harder commute to get there. But yeah. There any other things for the competitive housing space? I think that's it. Okay, so pretty cool. Not too bad. So pretty interesting stuff there. Now, Yardi does they go above and beyond. They it's just like too much data. Like I'm gonna have a tough time going through all this, but I highly recommend if you're just into this, like just going through it like one time or a few times and just sticking to the facts or the pages that you think kind of stand out to you or like I guess mean the most to you in drafting your opinion on the housing market or the multifamily market. But yeah, they do a lot here. So here is spread between multifamily and student housing rents is largest in the urban markets. So see University of Pennsylvania here with a large spread. Other campuses, University of Pittsburgh with a pretty large spread. So obviously with student housing, you're going to get more affordable options. Just because it's a more safer, I would say it's a more safer investment for investor owners because you have parents kind of co-signing on the leases. And if the students don't end up paying, then that collateral is backed by their parents, right? So it's a more safer investment in that sort. So you're going to see more affordable options in student housing. Let's see here. These are operating expenses. Interesting. Student housing conversions to conventional since then. Interesting. It's kind of a heat map there. Annual rent growth for smaller units. Pre-leasing activity. Schools with lower acceptance rates. Larger schools have leased up a bit quicker than smaller schools. Okay. So we're seeing higher occupancy in larger schools, obviously, than smaller schools. So I just wanted to track that rent growth metric. So wherever that is, annual pre-lease growth. Nah, this is occupancy. Oh, here you go. So, now, albeit this could be inflated. See 17.7% is a ridiculous amount. So they're probably aggregating or averaging out like new lease trade out, renewal lease trade out, brand new leases, coming to the market, and they're probably just averaging that number out. So it could be inflated somehow. I don't know how they're coming up with this annual rent growth, but yeah, it's pretty interesting to see. With the lease growth and pre-leasing, okay. Annual rent growth again with the leased option. I mean the lease growth. All right, there's a lot of data here. I mean, you can kind of pinpoint which market that you like the best, and then seeing which universities are in that market, and then nailing down like the specific data points that you can implement into your underwriting. So yeah. So if you are in like a student housing deal, I wouldn't go for like the average multifamily rent in the market just because it's a larger it's a larger base and you're gonna see more fluctuations or not an accurate growth figure with that. I would just kind of narrow it down to specific universities or just student housing in that country or that market, and then averaging your growth after that. Here's some sales volume, transactions that are happening, recent transactions. So you see some different joint ventures, acquisitions, partnerships happening, some forecasts, interesting. So yeah, a lot of great stuff there by Yardi Matrix. Oh, I think this, oh, okay. So this was the one. This is a lot simpler. That other one was like 82 pages, had a lot more information. So if you have some time, I would recommend just kind of going through or briefing through that. But this is a quick snapshot of like different universities. So universities here, so ones that stood out to me were obviously Washington State University, with the most pre-leased growth. And then some ones down here, University of Cal Berkeley, UNC, I think it's the Baker School for Real Estate that's there, University of Memphis in Tennessee, Alabama, yeah, pretty interesting stuff. So this is the leaders in pre-lease growth. So the universities with the most pre-lease growth. Now, rent growth is strong, but signs of cooling. Obviously, I think there's always a peak to any market cycle. So with rents, for that matter, you're seeing a peak here, which happened probably in the June, July months of 2022. Since then, it's kind of tapered off. New supply pipeline also starting to cool. So here's some quick data on the different universities and the bedrooms that are under construction. And then the percent that's already been leased out before it's even constructed. So yeah. So, University of Michigan, Ann Arbor stands out there. University of Maryland. UNC is obviously there too. Yeah, pretty interesting. Top 15 universities with the most sales volume. Tennessee, not surprisingly, sorry. UNC is also there. USC is there. University of South Carolina. I think they're the Gamecocks, I think, right? Yeah, South Carolina. Or that must be South Carolina State. I'm not sure. UPenn is here, with the most sales volume. UNC is also there. So yeah, sales in general has kind of tapered off in each market, or actually declined for that matter in each market. And it's honestly normal because I mean, rents are decreasing, right? There aren't that many I guess like worthwhile investments, like or you have to track like the best investments at the unicorn deals for say in that matter, but you have to find what works for you, which market you think or you feel the most confident in, and just backing it up by your numbers, right? But sales has definitely kind of struggled over the past few quarters. Top rent growth in the market. So this is University of Memphis, University of California, Berkeley, Cal Berkeley. A lot of ones that I recognize on this list. But yeah. So I mean anything above like even like 6 or 5% is pretty good. I would say this is it's a little inflated in my opinion. I would probably backtrack this like keeping an even more like conservative approach. I would backtrack this like 5% even when you're doing your underwriting, because if you underwrite for like 17% rent growth and think, oh yeah, it's just gonna keep increasing 17% every single year, you're gonna have like just absolute out of the roof returns, right? So if you are gonna do that, kind of taper it off, like start it at 17%, but then kind of keep trickling it down like a percent per year or something. Obviously it depends on your hold period and how long you plan to operate the asset. But yeah. So yeah, that was a quick overview of student housing. Some great data. Honestly, so here's some I guess pro market tips that I would recommend. So if you are kind of interested in expanding your knowledge in the market and just seeing different reports and data points that you can kind of base your underwriting investment analysis off of, I would just recommend just going towards like brokerage reports. And they literally each brokerage firm probably posts like a handful of reports in their market research and insights tab. And you can find the ones that are in your market and kind of formulate your own opinion in your market. So that's what I've done here. So I have like a nationwide research tab here, which I track all the nationwide stuff. I have a Florida one here, a Carolinas one here, Mid-Atlantic East Coast regions one here, Southeast regions, Tennessee, Central regions, right? So I've just been kind of just accumulating all these different reports and just tracking it that way. I think that's the best way to keep your opinion up to date and just keep up to date on how the market has been performing as of late. So yeah, if you guys found this video helpful, keep tuning in. I'm gonna be posting a lot more, but just if you have suggestions for new videos, would also love to hear them in the comments below. And thank you again for watching. And stay safe. And hopefully you guys have a great start to the 2023 year. You're sticking by your resolutions and you're off to a great start. So wish you guys nothing but the best. If you guys have any questions or inquiries about our company or would like to invest with us, give us a call. And our number is on like the website, and you can also learn more about syndication deals through our platform as well for upcoming deals. But yeah, so thank you again, guys, for watching. Appreciate the support. I know there isn't a lot of subscribers at the moment, but just gonna keep churning these YouTube videos out and look forward to a lot of great more content. So I said that weird. A lot of great more content. A lot more great content. There you go. All right. I'm getting tired. Okay. Appreciate you guys. Have a nice day and a nice weekend.